our September capital market and financial planning review. So I'm going to go over to the actual post. We're working with new second month here with new software, so hopefully this is going to improve each month as we get it working. So here is the actual post for those of you that are listening. The first portion of this post, again, our September capital market review, is the emergency fund. This will come out in the newsletter, and it's also in this post, and I wanted to review it. The emergency fund is one of the basic foundations of financial planning, and it's often forgot. It's so simple. The real thing, a couple of things to remember about the emergency fund. It's not really set up for investment assets. Short of a mason jar, outside of your, I'm exaggerating, but short of a mason jar, you want those funds very accessible and very safe for a rainy day. So those funds need to be invested very, very, you want them to work. You don't want them to just sit there and be under the mattress, but those aren't truly investments. The higher exposure that you may have, the bigger your emergency fund will need to be. Generally, as we go through life, especially in your working years, you have higher liabilities, higher cash needs, and so your emergency fund goes up. So I mentioned 4 or 5 items on reasons to have a higher emergency fund, and 3 or 4 items on reasons if you have dual income, very stable job, or fixed income, that may allow you to have a slightly lower emergency fund. All right, for those that are listening, I'm scooting on down to the next portion of our financial planning tip, and it's high deductibles. So this will also be in the newsletter, and basically it just talks about the 3 areas that I talk about in this are auto insurance, homeowners insurance, and health insurance. And the higher your deductibles are over the long term, the greater the savings. Now, I want to also, I put a break-in in here. I want to also let everybody know that not everybody on everything needs a high deductible. There are certain health issues that may deem it that where you would want to have a lower deductible. That's the main one. Auto insurance is almost always a good job. The reason that this article spawned is because if we have a good emergency fund, then it lets you have high deductibles, and it ultimately can be a savings for you. All right, let's go on down to our capital market interest rates. All right, this is for those of you that are listening, this is a big, busy chart, but basically what you're looking at is when interest rates go up, there's a little bit of pressure on bonds, and it's not, it's an inverse relationship. We've come from a very low, I'm reminding everybody, we've come from a very low interest rate environment, one that I hope we never go back to. And as we come off of this zero interest rate and they slowly start raising rates, we're seeing bonds with a little bit of headwind. So that ultimately is a good thing because, number one, the rates are going up, and that means our economy is growing. And number 2, we're going to get a better yield. So I'm just reminding folks that we may see a little pressure on our on bonds as these rates come up, but it corrects itself. We ride that yield curve back up. That's it. That's for our September capital market financial planning review.